water. So first and foremost, good afternoon, everybody. And thank you very much for taking the time to register today to join Investor Cube, who's hosting a call today with Abaxx Technologies, a company that Investor Cube has been a part of and involved with for, I guess, since they've gone public, certainly before they even went public. We are fortunate to have with us Mr. Josh Crumb, founder and CEO, and Mr. Joe Raia, founder and I believe the chief commercial officer of the company. The stock is really, we've been taking a lot of calls, a lot of interest on the company, especially over the last few months with a bit of the precarious markets that we've all been trying to navigate. We've been watching Abaxx bottom out a few months back, and then I guess in the summer around $10 range, and now it's rebounded back to $3 and is trending nicely upward. And of course, we're all very comfortable and confident the stock will go much higher, but it's been one of the best performers I've certainly seen over the last several months. And that being said, a lot of people started calling us saying, hey, what's going on? The stock has rebounded. It looks fantastic. Obviously, I speak to Josh, fairly regularly, so I'm fairly up to date. But I think it just became a good time that Josh and I were talking, everybody, a few days ago, and Josh thought, you know what? Why don't you just put me online with some of these people and let me update them, because a lot of people, as we all know, do like to hear from the horse's mouth. So I know people are not here to listen to me talk, but one, I want to just say, great job, guys, because just to see it even back at 3 in this market is an incredible feat. Also, I'm very excited about the update, Josh, you've given me recently, and I think everybody on this call will be very excited to hear what is happening with Abaxx Technologies, the excitement, and Josh will go through that, tell you what what's going to happen, where we're going into 2023, and we will at the end follow this up with a question and answer period, which we will limit because of time constraints. So if any questions are not answered, I will make sure that Josh does answer them, and we will email them to you. So we'll ensure every question is answered, but some of these things could end up going on forever. So not to worry, ask any questions, send them by email or chat. If we can't get to them on this webinar, we will ensure that they are answered and sent to you. And on that note, Josh, thank you again and Joe for taking the time to talk to us today. And we're really excited about the rebound in the stock and what the future of Abaxx sounds like. So on that note, I'll hand it over to you, Josh, and if you'd update us and tell us what's happening.
Sure, thanks, Neil. Well, I was going to start off by saying something nice to you, but I didn't realize there'd be homework. So, look, we had an investor call just yesterday, probably a much more formal update. We put out a project update last week, and our quarterly financials up on CDAR. And we're generally pretty transparent and publish all of our information online pretty readily. If you check our Twitter, YouTube, Smarter Markets, so there is a lot of information. So really, what I wanted to do here was, again, Neil has been a big supporter over the years, so we really wanted to just do probably more of a Q&A. Although with hundreds of people on the call, maybe it's not as easy to do the Q&A as a downtown Toronto lunch meeting or something. But really, I just wanted to be able to have this forum to do the Q&A with investors. But I guess maybe just to step back for a second, I don't know how many people on the call are new to Abaxx, so maybe I'll just to, if nothing else, but to set up the conversation. Give you a quick introduction to the company and kind of who I am and Joe Raia and where we're at. So actually maybe so first off, Abaxx Technologies is a market infrastructure company. We're really building new market infrastructure into the energy transition, and really what we believe is going to be another very strong commodity cycle over the next 5 to 10 years. And so, I know in Canadian markets in particular, that a lot of people aren't used to investing in market infrastructure companies. Perhaps, people would see a commodity cycle and think to buy, either, get into a CTA or commodity futures, buying the physical commodity, or getting into, obviously, what Canadian capital markets know well, which is, upstream oil and gas or mining companies. But we think there's actually a third, very important, part of this market is the actual market infrastructure. So what do we mean by that? So if you look at the way, I'd say most investors are very familiar with WTI crude oil. But I think if you asked most investors, and we're getting quite used to this over the last couple of years as we've been telling our story, is that a lot of people don't know the economics of how what the WTI instrument is, where it came from, the exchange it trades on, how does the exchange make money off of that. So really, what we're building is a new global energy market with a new physical focus on physical commodities, with our clearinghouse based in Singapore. So this will be the first commodity-focused clearinghouse in Asia, ex-China. And so we think there's a lot of opportunity as much more of the physical market and the trading market moves to Singapore, whether that's LNG and carbon markets, which we're very focused on, or on battery metals. But with that, maybe I'll step back for a second, introduce Joe Raia, who's on the call, and then I'll talk a little bit about the economics of our business and where we're at. So Joe, do you want to give it an introduction?
Sure. Thanks, Josh. Yep. And thanks, Neil, for having us here. And just as a quick intro to myself, I'm a Chief Commercial Officer. I've been with Abaxx and the team since now just about 3 years now. And I came over from Goldman Sachs, where I was the head of MD and head of clearing for commodities in the US and for our commodity clients globally. Before that, I spent 12 years at the NYMEX. I was the head of the energy and the metals markets there. And to Josh's point, we saw the buildup of WTI, Henry Hub, some of the physical commodities that the exchange had on as legacy contracts for many years. And then we started adding OTC cleared contracts and Clearport and cash settled instruments. We kind of swayed away from and moved away from the focus on physical commodities, and really felt it was easier at that point to launch cash settled instruments that that would be based on indices and not the actual delivery of the physical commodity. And I think that the tack that we took here was seeing the need for a buyer and seller as last resort, as we like to say a lot, where the exchange can stand behind the delivery of a physical commodity, whether it's LNG, carbon, battery metals, precious metals, and other products too. And I think the beauty of having our own clearinghouse, building it, the hard part is actually building it and the capital that's required for it and the time that it takes. But the beauty part of it is that once it is launched, we do control the products that we launch. We can be more responsive to industry needs, like we did at the NYMEX back in the day. I launched almost 2,000 products during my years at the NYMEX, after the exchange only having 5 or 6 for about 100 years. And by interacting with the marketplace like we have done here at Abaxx, we really have found products that the incumbent exchanges have ignored over the years and have moved away from physical commodities, and there is a distinct need for adding these for risk management tools and for better price transparency, and as we say, being the buyer and seller of last resort. So hopefully that's a good kind of quick intro. Maybe Josh, I'll give it back to you to go into the economic side of things.
Sure, absolutely. So again, we do see a very large opportunity to really be an exchange that's heavily focused on risk management and creating new derivative projects for the supply chain. Particularly European LNG has been obviously a very important, page one geopolitical and economic topic. And I think we can, hopefully give everyone on the call some updates on what's going on in European LNG and how, and how our market infrastructure can help that situation in Asia. So we can get into that a little bit, but maybe again, stepping back, what is the business model of the exchange? At the end of the day, if you look at something like WTI crude oil, as again, as an example, this is a contract that trades millions of lots a day. Now, at the end of the day, well, maybe I'll use Henry Hub natural gas because it's probably a little bit closer to what we do. So, very roughly speaking, I know these prices move around a lot, but say, the contract notional value of Henry Hub natural gas is about $50,000 per contract, and the exchange will basically make $1 every time that contract trades. So if you look at the WTI if you looked at that as a standalone product or standalone equity, that's probably about 10% of the global revenue of the CME group. A $500 million plus per year product. and a trade in that product makes probably about 80% gross margins for the NYMEX, which is now part of the CME group. So WTI alone, would probably be a $5 to $6 billion market cap company if it was just that product. But of course, again, the exchange trades thousands of products across commodities, equities, rates, currencies, and so forth. So what we're building as what we like to say is a full stack exchange. Both the exchange and clearinghouse will allow us to build something very similar out in Singapore. And so that's really the economics of what we're doing. So so what are the core products, and again, where do we see opportunity? So we're not starting an exchange to take their products and just compete. It's not like we're starting a competing equity exchange that's going to trade the same equities as another exchange or something like that, or even commodities. We're really focused again on those physical commodities that are not currently being serviced in our view by the big exchange groups. And so these are new commodities that are up and coming as far as their development of spot markets. And eventually their development of futures markets. So this might be analogous to when Brent crude oil really came onto the scene as a major, important global commodity market, in say, 2009, 2010. So before that, when people talked about oil, they almost always talked about WTI. But as there was a shift in, the U.S. really being the center of the energy market to the growth of China and emerging markets, where you saw seaborne oil markets, Brent crude oil became a major contract. So we think that same commodity shift can happen where new contracts that you're not used to seeing on your screen will emerge. And we think, three of the biggest, groups, particularly within the commodity space, is liquefied natural gas. Again, we believe that in 5 to 10 years, that LNG can be a global market. I should also say that WTI is one of the top global derivatives traded globally. That's across all sort of different financial asset classes, and we think LNG can be something similar. So this really can be the anchor of a new global exchange, just like WTI is for CME NYMEX, and just like Brent crude oil is for the ICE group. But then, in addition to that, we also believe that voluntary carbon markets, as they emerge from what was really a sub $1 billion market to a $100 billion plus market, it's also going to need this type of derivative instrument, and one very much focused on the delivery into the supply chain. So we're doing a lot of the work on voluntary carbon markets. And then I guess the third part is really the bucket of base and battery metals. Earlier this year, there was a really a major market event in that the London Metals Exchange, which has really been the home for base metals as a global market for probably over 100 years. They ended up having to break trades, which has really killed the liquidity, particularly in markets like nickel, but really across their market complex. So we think there's a new opportunity to list new contracts, not specifically the metals and the market structure of the LME, but a competing market structure out of Singapore. And so we think there's a big opportunity in both commodities that are not yet benchmarked, like LNG and carbon, but also in sort of rethinking markets like the battery metals. And all of these will be very important. And again, we think as buckets, LNG, carbon, and metals, we think these are all $500 million plus a year markets, very much like Henry Hub or WTI. So I think that's the overall, sort of business model. So where are we at today? So I'll give you kind of an update of where we're at today, and then maybe turn it over to questions, because I think that's
Josh. I'm sorry, Josh. Can you just one thing that's been coming up a lot, and I just wonder if you could just touch on this, is every major corporation in the world is looking to go to a zero carbon footprint.
Right.
And you talk about carbon, for example, Joe, and we've talked about this. I think there's a bit of confusion. So Abaxx would launch carbon, like people are buying carbon credits, for example. Can you just tell us, because it looks like it's going to be obviously a massive industry like an LNG. Could you just tell us a little bit about what is Abaxx's role in that carbon market? Is it launching products that I would buy to offset my footprint? Or can you just tell me, because it's such a gigantic market, you hear more and more about it, but it's still quite confusing, guys. So maybe we could just, it seems to be of such interest to everybody. Could you just touch a bit on this carbon market and how, and because some of your smarter markets, you've talked about this as well. Maybe tell us how you're going to capitalize and again, make money and monetize through this and what the real opportunity, because I know you've said it's gigantic. Maybe you could just elaborate a bit for us on that?
Sure. Yeah, absolutely. So really, when we talk about the carbon markets, again, there's not necessarily anything new about the carbon markets, but I think what's new or what, and call it, carbon 2.0, which we're moving into, there's really two types of carbon markets. First is a cap and trade market, and this is what's already very active in places like Europe, and Quebec, California, China. I think now about 40% of global industry is now covered. Obviously, because China's getting into this market structure, is covered by cap and trade. And really, what that is all about is basically setting a ceiling, saying industries covered by this sector can only emit certain amount, and those that are more efficient can sell credits to those that are less efficient. And so really, you create the market mechanism by people being above or below some sort of ceiling. So this is a cap and trade market that already exists in Europe. What we're involved in is the voluntary carbon markets, which we think can be very, very big. And really, what that is, it's a bit different in that it uses the word voluntary, but at the end of the day, as more and more Fortune 500 companies in particular, including most of the major extractive resources, the oil and gas and mining companies, as they make their pledges to where they're going to cap their emissions for 2030 and 2050, they're going to try to reduce emissions as much as they can in their supply chain. But of course, given the nature of their business, that's going to be very, very tough. And so they're going to actually have to go out and offset by investing in carbon reduction projects elsewhere, or buying voluntary carbon credits from, again, say a reforestation, or the company that we created in spun out based carbon. They've been focused on efficient cook stoves distribution. So there's a lot of methodologies that have been sort of tried and true, and I have the peer review of how much a particular investment opportunity will lower emissions, and these credits can then be sold on to those that can kind of no longer reduce their emissions. So but maybe Joe, do you want to maybe add to that again on how we build a market infrastructure for that?
Yeah, it's interesting. I mean, it's actually started as the genesis when we were working on the LNG futures contracts. The marketplace was telling us that, and this was well more than 2 years ago. So we felt like we were kind of ahead of the curve on this even before, and that's how new this market is. I would say it's 2+ years old, right? I was around with Carbon 1.0 with the Green Exchange at the NYMEX and saw how that marketplace developed and then somewhat died. But now it has come back in full force. And as we were developing the LNG contracts, the trading firms that we were talking to help us build those specs said, you guys better think of, or have you started thinking about carbon? We're starting to bring in origination people to start trading carbon alongside of LNG and other commodities. And we started our work then. We held working group committee meetings with pretty much the trading and banking and broker representatives of the industry under NDA, and worked on the spec. And I think that's how we came up with our LNG contracts, and I think that's the good practice in how to develop products no matter what they are. And then certainly in carbon, it worked that same way, where there was a general consensus on what the structure could be and how is it different than what's out there now, right? As Josh said, there's various markets. There's compliance markets in Europe. There's U.S. regional RGGI or greenhouse gas initiative markets, and then there's the voluntary market. And we felt that, and the industry and trading firm marketplace felt that there was a need for a better instrument in the voluntary markets based on different projects, but different nature-based projects, different depository into the registry, and then also how most importantly is the delivery aspect. And I think a lot of people kind of don't focus on that too much. They look at just the headline list of what's the what's the project, what's the nature-based project that it's based on. But instead, the delivery part and the retirement part is really critical, and that's where we, when we developed our product, went a different route. Basically, we went a more traditional route that the marketplace and the trading community was comfortable with for physical commodities, delivering, say, New York Harbor heating oil or gasoline or WTI, where the exchange and the clearinghouse, from a risk management perspective, stay in the loop of the delivery, versus the incumbents today, with their delivery of their carbon project, basically hand off the delivery to a non-regulated entity, and another one that doesn't basically take any legal responsibility for any screw-ups in the contract or the delivery. So we kind of went the more traditional route. We think that's the way that the marketplace wanted it, and certainly is more comfortable with. And I think when we launch that, we'll see. We have a lot of firms that are interested in being on board with us day one. So we're very excited about that.
Perfect. Thanks, Joe. Neil, did that answer your question?
Yes, it very much so, very much so. And while we're here, because I see some questions that I have from previous people I've been talking to, guys, if I can just run a couple other things by you, and then yes, we can open it up to anybody that has a question that's part of the webinar. So one is obviously path to revenue. 23-24 is a big question. Obviously spent years building this infrastructure. So I guess the two biggest things I've been hearing or been asked, Joe and Josh, is path to revenue, obviously what we can expect in 223 and that path to revenue. And then two, with obviously being in Singapore and being in the Far East, COVID, supply chain issues, is that behind you now? Can you give us, because we're over here on this side of the world, can you give us kind of what the environment in Singapore is like, from an economic environment, the COVID, supply chain / those kind of issues, are they all behind Abaxx now? Or so I guess those are two of the most common questions the last few days, guys. Josh, Joe, I've been hearing. Maybe you just comment on both those items.
Yeah, absolutely. So that was where I was gonna go next is, so we've invested about call it 30 million into Abaxx Singapore, which is our subsidiary that holds the regulated clearinghouse and exchange. And this is really a process we started, I guess, earnestly in about 2019. So it took us really about 2.5 to 3 years to get our approval in principle regulatory licenses for our exchange and clearinghouse in Singapore. Now those approval in principles do have conditions, that we're basically finalizing now, so that we're really internally ready to launch the market early next year. And so when we look at from a revenue perspective, what's still needed. So we have submitted our carbon contracts. So on the exchange regulatory side, we have submitted our carbon contracts, and we're in the process of submitting our LNG contracts. Our battery metal contracts will likely come, sometime early next year. So likely not too far behind the launch of the exchange. We actually still may be able to launch those at the start. That still remains to be seen. And then the second part is the clearinghouse. The clearinghouse is probably the more regulatory complex part of it. And really, the key pieces that the regulators still want to do is we put a lot of time and effort in rebuilding a lot of upgrading a lot of our software platform and our IT systems. Really, just as we've been building for the last 3 years, I think there's been a lot of new technological innovations that we wanted to work in before launch, because I guess as everyone knows in financial services, it's very hard to change the software and the engines as you're going. So we wanted to make those last upgrades, given some of the slowdown, given the energy crisis in Europe. We wanted to make our products more robust, but also make our systems more robust. So that's really the last piece from a regulatory piece, is working with the MAS on our new systems, so that we're in a place to basically take our full licenses early next year and launch the exchange. I would say there's another key piece of that is the regulatory capital. So the clearinghouse, will be part of the risk default waterfall. So we do need to have a minimum part of our own sort of skin in the game in the clearinghouse, which is the central counterparty to all the derivative trades happening in the market. So we do need a minimum of call it 10 million in regulatory capital. Right now, we have the working capital to get through launch, and we've got about a year's worth of working capital on our balance sheet. But we do need additional regulatory capital in Singapore. So those are the kind of the key pieces of the launch. Which I'm sure would go into the next question of, okay, so how will you be raising that working capital, or sorry,
Right.
that regulatory capital? And we've been working with industry partners and potential members of the exchange. This is a very common approach to launching a new exchange, is to have key members, key people that are going to be putting open interest in the exchange to be equity shareholders at the launch. This was typical in the exchanges that Joe launched with the Dubai Mercantile Exchange, the Green Exchange. This was typical when ICE got founded, and so this is a pretty tried and true method of bringing participants in the exchange into the equity. The difference with us, which is quite attractive, because we've got this public company, as a guarantor of the exchange. We can really bring in members on much less of a sort of risky startup basis. And also we can give them access to ownership in not only the exchange, but also the clearinghouse, which is really a strategic asset. So we've been talking to industry partners. We have not, again, we've made these disclosures, but we have not formalized the process yet. But that would be our first path to launching this exchange, is actually diluting some of the equity at the Abaxx Singapore level. So not selling new shares in the market of Abaxx Technologies, which is traded in Canada and OTC in the US, but selling the private equity out of the private entity, Abaxx Singapore, which holds the exchange and clearinghouse.
Okay, that was great. I think, but Jan, you want to ask us a couple questions? I see questions are starting to come in now. Maybe I don't want to ask all the questions, guys. So maybe Jan, I saw there were 1 or 2 questions I've already, or several, but maybe ask 1 or 2.
Of course, there's a bunch of questions here, both email and chat. So I'll ask you the first one. This is for both you, Josh, and Joe. The October 18th PR indicates that while the carbon contract has been submitted to MAS and LNG contracts are yet to be submitted, when do you expect to submit those, and or are there any dependencies prior to submission?
Yeah, no, that's a good question. So really, maybe gets into the process of what we do here. We really, again, it's very key that particularly our physical delivery aspects of our contract, the long form contract, is very well vetted by the industry. So on our LNG contracts, we've actually got a suite of contracts, given that this is a global market. So we've been sort of adjusting some of those, particularly given the energy crisis in Europe. And we've been very focused on a deliverable contract, LNG contract for Europe. So again, I'd say we're 99% done with that. So yeah, I mean, these are contracts that will get submitted to the MAS, very, very shortly, as we mentioned in our press release. I think there's 2 reasons to manage the timeline there. One is, again, this is a very competitive market. Essentially there's 2 or maybe 3 exchanges in the whole world that do what we're doing here. So we don't want to make those too public until we're really ready to launch the exchange. As far as the details of those contracts. So that's part of the timeline. But yes, those are basically all teed up. And again, we'll be launching the exchange with our LNG suite of contracts, as well as our carbon contracts and potentially battery metals.
Perfect. What are the biggest risks that Abaxx is tracking as you work towards the launch?
Yeah, so the biggest risk for us is really timelines, and this has been something that we've been dealing with in the market, and probably part of the sell-off earlier in the year before the recovery is we are dealing with timelines that they're not just in our control. At the end of the day, you're part of market infrastructure, so we're also reliant, and I can step back and talk about this a little bit, but we're reliant on the timelines of the FCMs. That connect to the exchange, and we're reliant on the timeline and the software development timelines of the ISVs, which are independent service vendors that actually connect our exchange to the trading systems of the banks and the energy and mining companies, so that when they trade our systems, it trades just like they're trading other exchanges. So we're subject to those timelines and the connectivity queues for that. And then we're also obviously subject to the timelines of the regulator. So this is always a very coordinated, or I'd say hard to coordinate dance of making sure internal and external critical paths are all coming together. But I'd say part of the recovery of the stock was in our Q2 report. We reported on a lot of progress and further now last week of progress with our FCMs project, progress with the ISVs, and again how that plays into our regulatory work. But Joe, do you want to maybe add just very quickly to the FCM side, because I think that's a key part of the market that's maybe not quite as understood.
Yeah, the FCM market is difficult to understand. They are critical, and having worked for the largest one in the world at Goldman for 7 years, but also seeing how FCMs interrelated with us at the NYMEX during my 12 years there. So I've seen both sides of it. I've seen which sides are profitable and which sides aren't too profitable, and who takes all the risk. And as Josh alluded to, the resources that FCMs need to allocate to connect to any new exchange or any new product is pretty substantial, whether it's a Goldman on the largest side or some of the non-bank FCMs like a StoneX or some of the other non-bank FCMs. But regardless, they are the critical infrastructure and part of the exchange. We just put out a white paper a few weeks ago, really, I think, putting a stake in the ground and reinforcing our commitment to the FCMs and their role in the risk management process. And so all that, risk management tools, all the tools that they develop and connect to us with at the exchange and their customers on the other side, it just takes time to really connect those pipes. And that's what we've been working on, really diligently over the past couple of years to line up the FCMs that will be our initial ones, which we have, as Josh alluded to yesterday in the call. We have one we're working on onboarding, and we have two that will probably come on board not too long after. And so they have customers that are telling them they want to trade our products, and that's kind of how it works. And so again, they're the first stop on the risk train, so they have to be absolutely certain that our systems at the exchange are of beyond reproach and are of top quality, and that's what clearinghouses do. You engage with new technology so that we can manage risk on our side, and so that the FCMs can be comfortable bringing on customers to trade our products, and that all the tools that go back and forth, margin calculations and fees and positions, all move seamlessly through the infrastructure. So again, they're a critically important part of it. There's been a lot of discussions about the disintermediation of FCMs and some of the exchanges going the route of not needing FCMs. We feel that they are conversely a very, very important part of the infrastructure, and hence we've engaged with those pretty much all of those that are involved in the commodity markets and the commodity futures markets globally.
Perfect. Thanks, Joe. So again, back to the risks, for us, it's always been about coordinating that timeline. And of course, how that plays in, of course, to any potential dilution or funding, rather than risks of people not wanting the market or something like that. So for us, it's really been about managing that timeline risk, and I think that's where we made a lot of progress over the last few months.
Sorry, I was on mute. Question for Joe. Could you elaborate on margin profile on the exchange, say 2 to 3 years out, and how the company could be in a position to utilize profits to fund growth, tying in owning the clearinghouse and launching more products?
I mean, you can look at the existing clearinghouses and exchanges, and particularly the ones that are tied to clearinghouses, and look at their margin that they post every quarter and annually. And it's just from my experience of working at the NYMEX for so many years, and then with the CME, the margins are high. I mean, we hope to get to that point. I would say that that would be, I think, a great achievement for us. But when you look at launching products on exchange, the initial cost is the sunk cost that you put in to develop the clearinghouse. As Josh said, the $30 million that we raised and invested so far to build the infrastructure of the exchange, to hire the right people. But after that, if you launch products the way and you interact with the marketplace to bring those new products onto the exchange. And then we think we have the right people to do that versus what's been going on in some of the other exchanges recently. We feel that we will be able to launch new products and innovative products that the market needs and have been overlooked by the other exchanges. So obviously I wouldn't want to project 2 to 3 years out. Probably Josh wouldn't want me to project 2 to 3 years out, but certainly I think that all you have to do is look at the other exchanges, and there's only a handful of them, right? There's only ICME and EEX and SGX. And so when you look at the clearinghouses there and you look at the margins, if they're publicly posted, which they are, most of them are, you'll see that they're pretty similar across across all the peers in the group.
Yeah, absolutely.
I hope that wasn't too evasive of a way to answer that question, Josh.
No, it was
Just to be careful. But it is, I mean, we are in a very small group of peers, right? And that's what we strive to be, is in that same area, and in fact, even better, I would think.
Yeah, and again, I think the physical nature, and maybe this is a good time to spend a couple minutes on again what's going on in Europe and why it's so important to have physical delivery markets. So really over the last few years, as U.S. Gulf LNG exports have increased, Europe was always sort of a dumping ground. If there was too much gas in the market, it was obviously cheaper to take it to Europe than all the way to Asia, particularly if spot markets were more or less illiquid in Asia. You saw a lot of that gas flowing into Europe. So it was really a dumping ground. It was never really set up to be a big LNG importer. It was really between renewables and their I guess deciding to really hitch themselves to Russian gas, particularly in Germany and sort of Central and Eastern Europe. So you really didn't have the LNG, either the import, the regas infrastructure, or the storage infrastructure, and so it really wasn't a market properly built to be importing LNG. So most of the LNG, the traditional buyers were Japan and South Korea, and of course China became the dominant player and the dominant buyer. But really, what you've seen is, because of COVID-0, China really hasn't even been in the market this year, which has allowed a lot of the LNG to flow into Europe. But if you look out, a year from now, it's expected to be or really for the next 2 years, because our next big wave of LNG supply really doesn't come on until 2025, 2026. So the next 2 years is going to be just a straight up bidding war between Asia and Europe for those marginal cargoes of LNG. And so if you don't have an actual buyer and seller of last resort market where you can go long futures and have that real price discovery for what someone's actually going to take delivery on, and instead you're just, so the other way that the markets work, and this is what CME and ICE have announced over the last few months, is that they're going to create an LNG contract based on a survey assessment of what is the surveyed price of LNG being purchased in Europe. But these are cash settled. You can't take delivery on these markets. So really, what particularly in a bidding war type market, you're really going to want to be able to take delivery and have the market really creating the true price discovery. So I would say over the last month, our partners, although they saw that we were obviously ahead of, we've been building this market since 2018, 2019. So, in those days, there weren't that many people talking about LNG as being front page news. But really, I would say over the last month, particularly after ICE and CME announced their contracts, people realized just how important our markets can be, that we've been doing the work over many years to create those physical delivery contracts. And so, sorry, maybe got away from the original point of the question, but I think this is just incredibly important on how important our infrastructure will be. And I think there's been a lot of recognition from the market and the FCM community to that importance, which is why I think there's been new acceleration and energy in getting our markets launched.
I guess it also shows that Josh, had pretty good foresight, because gas was pretty nothing. I never heard about it in 2018, 2019, and it's become mainstream. So I'm assuming that you spend time, or Joe, both of you and your team spend time identifying 24, 25, 27, what will be these next potential opportunities, the next LNGs, call them, for lack of a better way to put that. Because obviously your foresight on LNG was pretty dead on.
Well, I think the second wave is going to be technology driven. So I think, first we're gonna, again, plant our stake on being the best at creating new physical contracts for changing physical markets. But I would say after that, we've been developing a lot of digital transformation tools that allow us to go after share of existing markets, whether it's the oil market or others. So if we can also dominate in technology, so stage one is solving market needs that are right in front of us. Stage two is taking market share from other businesses by being the best in digital transformation. And I think that's another area that can be increasingly part of the story, a year or two from now.
Thank you. Go ahead, Jam.
This is a two-part question. Is the leadership team complete for launch, or could we expect to see some additional heavy hitters join? Not that Joe needs any help. Second part, the latest
Yeah,
the latest
look,
update referred-
Sorry.
this is
Just-
this is the dilemma I always face. I'm like the least qualified in the whole team to ever be the front man. Yet you guys are probably very sick of talking to me. But no, I mean, beyond Joe, of course, Dan McElduff, our president, launched Clearport, which was really the electronic clearing platform for NYMEX, and allowed, so Dan and Joe worked together and got that launched. Tom McMahon, my co-founder and on the board, was the chairman of the Natural Gas Committee that launched the Henry Hub futures market. Nancy Sia, who runs Abaxx Singapore, she was the co-head of Goldman's commodity business in Asia, and the chair of JR in China, Goldman's commodity business in China. Yeah, so you can go to the website, but we've got a very, very deep business of people that have done this before. But in addition to that, we will be bringing on more members of our board in Singapore. That's the other part. We've been more or less, just for flexibility, managing the whole company from Canada. But you're going to increasingly see, particularly as we bring in institutional partners in Singapore, we've got a key piece there. And yes, we've got some more people that will be joining the team in Q1. And then I'd say the other piece of it is being the best in physical markets, we have to go out there with the best traders. So beyond just the full-time employees, the people that are building our markets, like in battery metals, we've got a former senior member of Glencore that really had one of the largest base metal books in all of the world. That's really working on some of our battery metal contracts. And we have a former chairman of the LBMA that's working on our precious metal contracts. So again, the list goes on and on, because we want to be the best in technology, the best in commodities, and the best in exchanges. So it's a long build, but we'll get there.
Perfect. Please list and describe the battery metals, example, class 1 nickel, lithium, graphite, cobalt.
Perfect. So we got a question from one of our competitors. Perfect. No, we're not. It's been very intentional that we just say battery metals because there's a lot of opportunity in this market, and there's a lot of different ways to look at it. So that will come in time. But again, I think given our background and so much of the DNA of our investors, from Robert Friedland and others, come from the metals markets. So and obviously Canadian capital markets. So we're very, we know the metals markets. I'm actually a mining engineer by background. I worked with the Lundin Group, so we know metals markets very well. And we will be, I think, focused. I think actually this is an important point. We are focused on solving commercial needs first. We're not just looking at, okay, Eurodollar futures is a massive market, let's go work on Eurodollar futures, right? We want to build a reputation of actually solving commercial supply chain risk management needs first, not just listing the most profitable financial products. So even though some of those metals that you mentioned in the battery metal list are going to be just a blip on the radar compared to the size of the market of something like LNG, I think it's important for us to build our reputation as again, working with the industry to solve commercial needs, which is ultimately where we need to be for the energy transition. We really are in the engine room, trying to get that right so that we can get trillions of dollars flowing into these markets.
Okay. The latest update refers to a EU white paper being worked on. Seems like the EU deadline for establishing a new benchmark is March 31st, 2023. Will Abaxx exchange be able to intercept that deadline? In addition to this, do you plan on listing in other markets as the US?
Yeah, as far as the EU process, we do have relationships in the European Union, European Commission. What they're talking about is really a top-down, product creation out of a committee, that really has particularly a cash settled benchmark. You can almost, look at this as the LIBOR replacement committee. So it's a very different approach to what we do. We build bottom-up markets. How do actual supply chains work? And what risk management needs do they have? So, just as a perfect example, you can get as many people as you want saying this is a great, cash settled benchmark. We're going to take a little bit of this. We're going to take a little bit of that. We're going to survey this part of the market. But at the end of the day, if that doesn't match the physical delivery commercial terms of what's being sent into the market, it's going to be a very bad instrument for hedging. Right. And we've seen that in some of the problems in the LIBOR replacement as well, where, again, theoretically, it's a great market. But at the end of the day, if it's not actually meeting the hedging needs, it doesn't work. So, for us, we build from the bottom up. And at the end of the day, we're building from Singapore. So, we could have commercials using our market no matter what, the European Union says is the benchmark. It's what the market uses to hedge their risk that matters.
Okay, I'm just going to interrupt for a second because we are running out of time. There's a couple of really good questions. I also want you to just comment, guys, or I can comment just about the recent rebound in the stock, because obviously it's been incredibly impressive in the midst of this somewhat dismal market we've unfortunately all of us are experiencing. But a couple really important, I saw a couple really great questions. I just like to comment on one. What kind of, and I know obviously you have to be careful on this, but what is there anticipated news flow between now and year end, and kind of what we can look forward to, because news does drive price, obviously. Do we anticipate some regular dissemination of news flow on a, let's call this a macro level between now and say the end of Q1? Can we look forward to seeing more news on Abaxx coming out? And then two, in terms of, again, raising more capital, this has come up a few times, the company is going to consider doing an equity raise, let's say between now and Q2, or at this point, the company can fund their burn and is not, for the, let's say, following couple quarters, looking to do an additional raise of any kind.
Right.
Just
yeah. So we
comment
actually,
where you can compliantly on those.
Sure. No, of course. Yeah. The forecasting, press releases is always a good no. So look, no. All I can say is between now and our internal readiness, end of Q1 next year. Again, there's external, moving pieces, but there's a lot of things between now and end of Q1, because that's when we've targeted internally to be ready to launch this market. And of course, like I said, bringing in potential partners when we, again, I outlined all this on the conversation yesterday and in our disclosures. But yeah, if we had a formal process in bringing investors into the clearinghouse, of course, we would be disclosing that. So, again, there's a lot to do over the next 2 quarters. As far as our runway, again, we've got a 12-month working capital runway. And so we wouldn't look to be diluting before our transformational events over the next, 3 to 5 months. So like, look, we want to execute first. We do have a runway to execute, but of course we're always looking at ways to, to manage and plan A, B, and C in capital raising. But, and again, I listed some of those on the conference call yesterday, and because that's, to me, that's the biggest risk, is the timeline risk and dilution. So we want to do everything we can to avoid that.
So it's really doesn't matter if you grow, it says you grow to Q2, Q3, it's how fast you want to grow in correlation. Would I raise more capital, subsequently dilute? It's right. What offsetting that, offset on one side, dilution on the other, and obviously picking the best path to go at that time. But in the near future, you don't, obviously you're well funded.
Yeah, exactly. And then one other key thing to say as well, just on that dilution and why looking at Singapore, one, it incentivizes partners, with skin in the game. But the other thing is, we do believe we've got a lot of undervalued assets on our Abaxx tech balance sheet. Remember, we also own about 15% of Base Carbon, and we have a 2.5% gross revenue royalty on Base Carbon, and that royalty will start paying out in the second half of next year as Base Carbon starts producing revenue. We've got very large iron ore assets that can be that are actually quite ideally suited for green steel and decarbonizing steel. And then we've got we actually have a gross revenue royalty given our technology relationship with our subsidiaries. We've got a gross revenue royalty over the exchange, even if we dilute the equity. And then on top of that, a lot of our software. So again, we don't believe the market's yet valuing these because it's early. And of course, you guys know better than us that right now the market's looking for cash flow companies rather than 5-10 year stories, which we get. But as a builder, we don't want to dilute the value that we're building in those other assets either. And we don't think the market's valuing. So for us, it's getting the exchange launched and building internally to grow those assets.
Great, thank you. And then lastly, and again, there are quite a few questions. So again, we will ensure, guys, one, we are recording this call, so we'll be able to play it back at your heart's content. Two, whatever questions were not answered, we will definitely ensure that Josh and Joe and or combination thereof do answer them. We will email them to you. So not to worry if your question wasn't answered today. Because the last thing I just want to comment again, which I'm a small cap investor, a mid cap investor. I trade pretty heavily. Watching the stock go down, dollar range and rebound to $3 is overwhelming. And I guess a lot of that, one, I'm assuming it got way oversold. I'm sure we all believe that, Joe and Josh. But the fact we're already back at $3, I guess a lot of that is being attributed in your guys' eyes as management, that you're getting closer and closer to launch and that closer and closer to that path of revenue. And because your numbers are quite large on your revenue growth opportunity as you start to, get that path. Do you think that's been a real driver that people just see, wow, you're getting so close now? The stock's pretty damn cheap. And is that seem to be the main catalyst that's been driving the stock to go up by triple in the last few months?
Look, we don't spend a lot of time on the stock. I mean, at the end of the day, like what we're building is quite significant, and the relative volume and liquidity both in the sell off and the recovery are really just very, very minor. And look, I mean, again, people can look at the trading in the stock, but for us, we just need to keep our heads down and build the business. And again, I can do a fundamental bottom up analysis of our assets, some of the parts, and we'll do just fine on the stock price when we execute.
Okay. All right. Well, I'm going to just stop this now. First of all, Joe and Josh, thank you so much for taking the time. Again, I've been working with these guys for a few years, and always keep abreast of what's happening. I think, and this is now me personally talking, because I think the thing is a screaming buy, obviously, at these levels from people that participate in the high growth opportunities. Anybody who's known Josh and I've gotten to know Joe quite well, they know what they're doing. It's a very, very exciting time, and I think it's a stock that has to be looked at. I know a few guys at Richardson, Scotia on the phone that are, I know we're buying the low ones. Congratulations, because you were pretty genius there. But I still think, in my personal opinion, and I think a lot of the brokers, advisors, portfolio managers that we're talking to do think at the current level, which I believe it's around $3 right now, $2.90, the stock is still, and again, based on some of the comments Joe and Josh have made, the stock is still certainly very early stage in our eyes and has significant upside for, again, people that play in those small and mid-cap markets. So thank you, Joe. Thank you, Josh. You guys can reach out to them or reach out to us, Investor Cube, with other questions today, a week, a month, a year. We stay in touch with Joe and Josh, and we do nothing but support Abaxx, and we're very proud to be a part of it. So thank you both very much. Guys, have a great day. And again, any questions, anything anyone needs, please let us know. If not, we'll also email everybody once we've got this. It'll be on our YouTube channel. So once it's up, and I'm sure they'll have it access, and they'll put it up wherever Josh and Joe like to put it up. So you'll be able to play it over and over again. And again, Joe, Josh, thank you very much.
Thank you, Neil.
Thanks,
Thanks for your
Neil.
support. Thanks, everybody.
Thanks, everybody.
All right. Have a